Good evening and welcome to this week's episode of Sunday Night Live, your favorite automotive show where we talk about all those things that improve the customer experience at your store. And every week we bring on the experts to share with you what they do or what they've done to make things better in the auto business. Because the better experience they have at your store, the better the overall automotive business is perceived. And more customers will come to you. They'll bring their friends, their family members, anybody and everybody that they know will know that yours is a great place to do business, and they will come to you for everything they need when they need it. And tonight I have my good friend Paul Machin from Black Book on with us. I just want to give a disclaimer up front there. He is having some streaming issues, so we're hoping that everything's going to work out perfectly. But in the event that it doesn't, he may have to switch devices, and then we'll talk through the numbers as opposed to showing the actual slide. So welcome, Paul. Why don't you let everybody know a little bit about you for the few folks that may not know you.
Hey, Paul, thanks again for having me here on another SNL. I think we've done, 3 years now, 3 years running, right?
Yeah, into our fourth year.
What a rush it's been. So that's right. All right, so
Paul, the screen is frozen. I don't know if you can hear me, but
a little bit about me, lifelong veteran. Was that? Did I?
It's freezing up.
How's this now? We should be good now.
It's buffering. Right. You may need to.
15 years in. Want me to? I'll call in. I'm gonna call in.
Yep. Why don't you log in via your cell phone? So just bear with us as we get this rectified here. So on tonight's show, what we're going to talk about is what's happened for the first 6 months of 2023, what the data reveals, and where it's headed. We're also going to talk about some best practices on what you can do to improve retail automotive sales at your stores. Real actionable content that you can start using tomorrow to generate more business for your stores.
All right, it says I'm logging in. I'm gonna cut off here.
Okay.
There we go.
Oh, much better. Yes, that's much better. Yeah,
so maybe now we can use technology today, right?
Yep, that's it. As my good friend David Kokenauer says, it's technology, man. 70% of the time it works. The other part of the time you just kind of have to work around it. So that's what we're going to do.
And that's the creative side of us being flexible, right? Trying to figure it out.
Paul, we just lost video.
There we go.
All right. We got Steve Cheshin says hi. Russell B. Hill. Hello, everyone. What's on tap tonight? Hello, Paul. And Russell B. Hill says, The Matrix. David Alto. Love seeing you live, Paul. Thank you, David. He says, user error. All right. So tell us a little bit about who you are, how you got here, and your background, my friend.
So I'm with Black Book Data and Analytics. Director of global and U.S. accounts. My main area of expertise on the DaaS side of the business is with startups. So I tend to engage quite frequently with many startups to try to help them put together their go-to market strategy using Black Book data so that they have something different. Been in the industry 30 some odd years. First half of my career, retail. So just like you, front to back, top to bottom, I'm very familiar with what it takes to operate and run a dealership today. And the last half is I've been dragging dealers into the 21st century, kicking and screaming. Sometimes I feel like I'm pulling them by their nostrils. You know, yeah, just dragging them, just trying to get them to update to a fully integrated. Digital retail solutions, for instance. I've been talking about that since 2003. With my dealers, and and now it took the pandemic to make it a reality. So it's been a cool run watching the evolution and how quickly the industry has adapted. And today we have a much more receptive dealer body.
Absolutely. Absolutely. All right. So June just turned the page. We're into the second half of 2023 now.
Right.
You talked to us about some of the data, what's transpired in retail sales over the first 6 months of the year.
Perfect. So, first 6 months are behind us. And as you know, I like to break things into two components, right? The first part I like to talk about is what is, as you're familiar with, a rising tide raises all ships. So the first portion I want to share is my perspective, my insights and experience of what I'm hearing and seeing, and trying to connect the dots so that when we dive in to the Black Book data, it makes more sense. It's just not a plot or chart of numbers. I wish I could share with you, but please make an interactive, ask me some questions. So we know about the last week, the Fed, 2 weeks ago, they did a pause on interest rate hikes, right? And what was interesting about the way they did this pause is that came after 15 months of interest rate hikes, and it was the highest rate hikes in 4 decades. 4 decades, right?
Wow.
So it's almost like you want to knock over you want to crumble the castle. That's the quickest way to do it. Is keep on bombarding the walls, right? So right now, average new car mortgage rates are hovering right about 7%. Average new car rates still, if you're not qualifying for OEM interest rates, you're between 6 and 7. Average new car rates are 8 and 9. And I'm like, wow, you know what this feels like to me? Early 90s.
Right.
So I'm like, okay, yes, it's really not that big of a deal until you really get underneath the layers and start peeling back the artichoke to get to the heart. But within all what I'm going to share with you, Paul, there's some great news if you're an independent dealer or if you're a savvy franchise dealer with a well-run service department, reconditioning department, and a used vehicle department. There's some powerful news here. So what accelerated, what prompted this pause? My personal opinion, we had 9 major bank failures. We know of 4. So who are the other 5? Media's not been reporting it. And one of the worst, it became the biggest in history, SVB Bank. Well, did you know that just 2 weeks ago, we had an investment company, an investment firm that decided, they made a educated choice to return to formerly successful hotel properties and walk away from $775 million in a commercial mortgage-backed asset, right? They just made this, they looked at the numbers, said, it doesn't make sense for us to keep paying this bill. We're out. A week later, a major retail mall did the same thing. They walked away from nearly $500 million in retail collateral mortgage-backed assets. And that's just 2 that's been reported. You keep your ear to the floor, I can promise you there's a lot of that happening in the commercial mortgage-backed security space. Now, guess who owns the majority of those kinds of investments? Retail investors. Your pension, your 401k. We're one of the largest investors in those kind of platforms. And then you have people in very high places that are very well connected who are investors in these. Hence the reason why SVB, if you had a deposit in excess of $250,000, you got protected and you were not supposed to be. So friends in high places who are also part of, we're going to be experiencing a problem, helped us, right? So now there's really good precedence there. So we cannot take the lack of good judgment by the Fed as a way to say, oh my God, the sky is falling. But here's the reality. When the cost of debt exceeds the cap rate, which is an investment term for real estate, you lose money. These are, so Translation. Let's translate that. When your cost of floor plan exceeds the asset value of your inventory, you're losing money. The lender's losing money. You're at incredible risk. So it's happening in the commercial mortgage-backed security space already, and it's happening in a major way. So when you have the mortgage, credit card, student loan forgiveness, that's been nixed, right? So all these millions of Americans who have not made a student loan payment 3 years now, 2 years now, are now looking at having to start making that payment they didn't think they'd ever have to make. And some of these kids have or I should say young adults, $600 mortgage payments. That's on top of already tight budget due to the current market conditions. We have another investment firm called Starwood. They're shopping 2,000 single-family rental properties because they see the risk. They did an asset valuation, a portfolio analysis. You and I know it as a water report when we walk our inventory every week, right?
Yeah.
If any savvy dealer knows, they got to understand the value of their assets weekly because it changes weekly. Well, here's a company, a major investment. They're shopping 2,000 real estate single family homes because they know they're underwater. They're trying to recoup some of that water. They don't want to drown. They're hoping that someone will mitigate their losses by bailing them out by overpaying for some of the properties that they have there. That's what they hope, right? When you take the fact that mortgage forbearance, now that the student loan debt is not going to happen. What are some of the other things the government's trying to do? Well, people with great credit who are still actively engaged in the marketplace today, they put a stipend where you and I now have to pay an extra 0.5 point or a 1/4 basis point in our loans so that lenders can turn around and offer a lower interest rate to a credit challenged consumer who's trying to buy. So it's kind of, we're helping these companies stay profitable, stay afloat, and help them do business with people who have been less protective of their credit, so to speak, right? But I don't know about you. I was not offered any equity in any lender who's going to profit off of that program from my hard work, discipline, and delayed gratification. I'm not going to receive a dividend check. Are you?
I don't think anybody is. That's not how
I don't think anybody, but we're being forced to do it now. We're being forced to do it. It's a part of your credit card statements. It's built in as extra fees. It's if you're trying to refinance your home, it's a part of that fee that's in there. And it's ridiculous. They just can't do that. So what does a dealer need to do today? They got to plan on adjusting inventory levels to demands. And here's the key: local market. How are the local markets responding? Don't just take this national view, because that's what the media. What is your local market doing? There are some markets in this country that are just on fire, right? But there are some really big and heavy markets that are hitting the tanks. And those are the dealers I think need to be smart in analyzing their inventory. They need to understand that in their local market, what is the increase in foreclosures? What is the increase in evictions? What is the average income levels with those that's there? Because usually 6 to 9 months, repossessions start to happen.
You know,
let's take a look. Go ahead.
What's interesting is that there's so much on everybody's plate at the dealership. Okay. Honestly, I don't think anybody's looking at those numbers. What they're looking at is what cars are selling for now, what they need to pay, what their costs are. I think they're looking at that, but nobody's looking at the bigger number behind it that you're talking about here.
What's driving the economy? What's driving my local economy? I'll never forget one of the earliest lessons I received when I was just starting out my career on the retail side of the business. My father in the car business, he gave me a break. He raised me up, taught me everything I need to know. And one of the rules he says is pay attention to your new car sales in your market. Because typically what happens after new home sales, 6 to 9 months, people want to have a new ride in the driveway.
Yeah.
So if you can figure out a way to create relationships with, and this is one of the things I used to do running my stores with real estate agents, I'd give them a $100 spiff every time they referred a new home buyer to me. Just because all I wanted to do is say thank you for investing in my community, buying a home. If I can help you in anything, sales, service, I'm here.
And how many people are doing that today?
Because they're not, like you said, very few are paying attention to the main drivers of our economy, which trickles down to our automotive vertical. Right? So that's why you got to connect all these dots. Think about the stimulus money, right?
Yeah.
If I could show you this graph, I wish I could. I mean, it's really, really telling. It shows the spike when everyone started getting these stimulus checks, and all of a sudden the economy, quote unquote, is back on track, right? You know, we're doing really, really good. But since March of 2022, it's been flatline. You know, and that's a Fed stat, and I'll be redoing this as a blog. So the harsh reality, we are a consumer-driven economy, where our economy is dependent on all of us to spend all of our income plus, meaning we spend all our money. Now we got these credit cards to stay afloat. That's typically what they are hoping for. And for the last 15 years, we've had easy access to low rates and easy credit. And every child that was 8 to 12, 15 years ago, are now young adults. They've been raised on credit. They've been raised to use every single dollar they make to pay bills and then manage that credit. And those are the people who got hurt the most, that are now, when they were prime, they're now near prime or even a subprime consumer. But here's the key. When I talk about this is a boon for independents and savvy used car franchise dealers. They know how to keep their payments good. They may be charging off some debt, but guess what they need? They need a reliable, dependable used vehicle, and they know how to make a payment. So in keeping with the same strategy, you know, how investment companies are making strategic decisions to walk away from these investment properties, so too are consumers are doing voluntary repossessions on their inventory, on their own assets, on their own cars, because they can't trade out. You want to guess why they can't trade out?
Because every car came standard with a bottle of embalming fluid. 84-month terms.
84-month terms, 10 grand over sticker, right? 10 grand over sticker. Or how about this? You financed a 2-year-old vehicle with 35,000 miles, 472 payments. And by the way, you paid 5 grand more than that car sold for brand new.
And the banks financed more money than they should. That 110%
Correct.
went out the window.
All of that's coming together, right? That perfect storm analogy is starting to come together. So we have an intelligent group of consumers, like these investors. They're analyzing their budgets. They're taking a look and saying, we can't afford this car payment anymore, whether it's $800 a month plus insurance and gas, or it's $1,500 a month plus insurance and gas, right? And maintenance. They realize they can't sell it. They can't trade it. They're actively, I know of 7 different stores that they've told me that consumers said, look, I know I can't trade, can't get out of this vehicle, but I can buy another car now. My credit's still good enough for me to buy another car. I want a $500 payment. Show me what I can buy. They get into a car, they got that $500 payment. They're parking that overpriced, too high payment in the driveway, waiting for the voluntary repo. So I'm calling this ripping off the Band-Aid. It's coming. We're ripping it off. You know, when you combine all of this together, it's just a matter of time before this flood is in front of us of an incredible opportunity. If you're a savvy independent used car dealer and a savvy used car franchise dealer, because you've got some incredible opportunities. You know, with the top 5 things I think dealers need to pay attention to that we've learned over the last 6 months. Number 1, everyone's concerned of economic uncertainty and higher interest rates. So even though we have a pause, the Fed still said they're going to have 2, maybe 3 more interest rate hikes before the end of the year. Record levels of debt. We have the highest new car portfolio finance ever. It's higher than what the mortgage collapse was in 2000. Mortgage collapse was like 1.3, 1.4 million in 2008 through 2010. We've got that alone in automotive asset-backed securities right now.
I want to jump on that. Hold on one second. I want to get to a couple of comments, and then I want to jump on that. Ty Thompson, hey, Paul.
Hey, Ty.
Savor the flavor of the awesomeness in you, sir, for sharing your delectably, scrumptiously, delicious, edibly tasty, good, heartfelt thoughts with us today. I love this guy. It's 85 degrees in Sugar Land, Texas, just southwest of Houston, but feels like 94. He says, Paul, savor the flavor of the awesomeness in you, sir, for sharing your yes. And Ty Thompson says, I identify as debt-free.
That's right.
Welcome.
Congratulations,
to the club.
right?
Welcome to the club. No greater feeling. Banks
And
are walking away. You know, you talk about these huge portfolios, right? That they have now. Just as the mortgage banks are looking and deciding that they want to pull back the reins, so are automotive lenders. There are lenders that are pulling out of the lending space as we're having this conversation, and of the ones that are staying, a lot of them are tightening up the ropes, right?
Right. They have to, right? You know, going back to, you know, the prime credit consumers and super prime are getting charged an extra point or basis point or some kind of percentage to help mitigate the cost of a loan for near prime subprime. Lenders are using the same strategy in restructuring their origination qualifications. They're saying we've got to be able to protect the assets we have so we can continue doing loans maybe at a more secure level. We know, right? We already talked about the two: rising car prices, longer term loans, and the most disastrous that's been bad for us has been these deferrals. Right now, lenders are doing more restructuring of payments in the hopes that they can help a consumer stay in that loan, stay in their car, so they don't have to repossess it.
They don't want
they don't want it back at all. They don't. And it's because of, you know, if they take it back, they got to go take it to the lane just like everyone else does. You take that vehicle to the lane, you're going to get your lunch handed to you.
What's the no sell rate right now?
54%.
That, for those not familiar with that terminology, 54 out of 100 cars that go through the auction lanes do not get sold. And is that primarily because the dealers don't want to take that hit?
Well, we've seen a couple things, right? So in June, with the market lost about 0.42, almost half a point in overall retained wholesale market value.
Yeah.
But the cautionary stance that we're hearing from dealers in purchasing vehicles has resulted in the lower auction rates and increasing days to term. But you've got think about these rental car companies that purchased pre-owned cars to put into fleet 2 years ago.
Yeah.
They bought all they're the reason why the wholesale values started to skyrocket, because all these fleet and rental car companies were going into the used car market because the OEs were concentrating on supplying the new car dealerships and not satisfying rental orders or fleet orders.
That's
so
huge.
Those companies was huge, tremendous. So we don't have this influx of that returning available inventory. But what we do have coming back is they went out and bought that 2019, 2018, 2020, 21 model and overpaid, put it in fleet or in rental. And I don't know about you, last time I rented a car, it was like 85,000 miles. It was nasty on the inside.
And double the cost.
And double the cost, right? That's right. So the retention index compared to, you know, yes, we're seeing a slight depreciation in wholesale market values.
Yeah.
It's like I said, the overall market was just under a half a point. Cars were, let's just say 0.44, and trucks were 0.41 as far as depreciation. But
yeah.
From what? From what, right? And this is what I have to remind everyone. And I was at NIADA last week, and every independent dealer. So when do you think the market's gonna bottom out? When do you think, wholesale prices are dropping? I said they're gonna drop, but it still won't be anywhere near pre-pandemic levels.
Right.
You have to remember, we entered this year at 151%.
It's like
wholesale,
right? I see the used car pricing go up and down, up and down.
Yeah, if I could show this chart, you would see that that we've been kind of flat. It was we started on the wholesale side, started seeing a drop because we're 26 weeks in now. We started seeing it the fifth week of the year. We started to see it uptick a little bit. So we actually increased. Okay, we started the year 151 points higher than we started, right? And then by the 5th week, we started going up above that, right? So we had a slight increase. And starting on week 25, started week 25, 2 weeks ago, we're starting to level out now. Where will it stop? I don't know. I don't know where I don't know if it'll drop enough to really to satisfy the affordability crisis that we have right now for people. My local Toyota store right down the road had 9 new vehicles in stock. I went to the Chevy store, loaded inventory, right? So
right.
we're
and the Dodge store. How many cars in the Dodge lot? How many trucks are on the Dodge lot right now?
Right. So there's the available inventory, that people say, oh, dealers are flush. It's not equitable, right? There's no equity there. The Japanese and the Koreans and some of the Germans are not full, right? But they've got decent supply of pre-owned inventory, where a lot of the domestics have plenty of inventory, and as a result, we're seeing an increase in incentives. Right now, we're about 5% across the board of incentives on domestics.
Yep.
That are there.
A comment here. Greg Tomazik says, this is some pretty frightening information. I'm actually very glad to be able to listen to this. This is, you know what? This is real information. That's the beauty of it, right?
Oh, yeah.
You know,
and
it's one story and the people tell another story, and somewhere in the middle lies the truth. I mean, we're in stores on a regular basis talking to dealers on the front lines. So, yeah,
yes,
it's very fascinating stuff.
So even though we're seeing a drop in wholesale values, our ability to retain our retail asking price as an industry has been it's been strong. Right now we're about 103% above the benchmark that we set back in January. Okay. So we're higher in retail asking price than we were, right, 6 months later. It remains to be seen if that'll start dropping. It usually takes 6 to 8 weeks. So we've got pretty much most of July, we should start seeing a depression in retail asking prices.
Yeah.
But as a warning, we don't have enough returning supply of pre-owned inventories going through the auction that dealers are used to being able to bid that's decent to put on their lot. Which begs the number one thing I keep sharing is you've got to create a third-party channel for sourcing vehicles independently. If you got a service department and you're not doing 100% service write-up with a service appraisal, a guaranteed check writing offer every single time, you're missing out. If you have not, as a dealer, created a We Buy Cars portal, that was probably the third question I was asked by almost every independent dealer. How do I buy more vehicles? And so I start describing what a We Buy Cars platform looks and feels like in their local community. That's number 2 strategy. Number 3, I always say that it's in the palm of your hand now. Our phones. You could use good technology that you can train your staff saying, if you do this process right, this is your check writing number. So everyone in your organization is now a buyer for your company, and they all know what you need.
I have videos out on my YouTube channel that talks about some best practices, some cheats, if you will, on how to acquire more used cars. I mean, it's not rocket science, but these are things that people overlook, right? I'm starting to feel as though some of these clubhouse rooms, they're nothing more than echo chambers, okay? Because you bring good information to light, and they just, unless it conforms with a sponsor or they say it, they don't even pay attention to it. It's crazy. And I think part of the problem too with the market now is that when the pandemic hit, we got used to, as a dealer, buying cars online, right? And I think we got a little bit lazy. Lucky Lopez put out a great video. I don't know if you had a chance to see that, where dealers were getting lazy and they're buying stuff off of condition reports, right? And off of Carfax. They're looking at this before it goes through the lane. And we all know that the information, the condition updates at the end.
Right.
And those ratings, they're slanted towards a new car dealer, not necessarily the used car dealer. So a car that's got a high rating this week all of a sudden has a lot lower rating next week.
I won't say any, I can't say the name, but I had a fleet company send me about 5,000 vehicles they wanted to send to the lane. And they said, here's what we think. Here's our condition grade report on all of it. And every single vehicle was a 3.2 or just under a 4. But all of them were 75 to 100,000 mile vehicles, 3-year-old cars, like 2021s, 22s with that kind of mileage. So it's like, you can't classify that as category 3.
Right.
Right. That's not a category. That's not a condition grade 3 vehicle. Like, what are you talking about? I said, well, it's got 100,000 miles on a 2-year-old car. It's not a class 3.
And you got to look at that condition report carefully, right? Because if you have a handful of hits, that's a sub 3 number right there. But yet some of them are going through the lane at 4+.
Oh yeah. So lenders, so we're seeing so there are repos running through the lane, right?
Yeah.
But the floors are so high because the lenders are trying to get out of them, and the condition grades are not matching the physical condition of the vehicle. So
that's what we're talking about.
One of the reasons why, it's my personal opinion, but I believe, our sell rate was 46%, 54% no sell rate.
Yeah.
That tells me that the vehicles running through the lane, too high price, condition reports aren't matching, and they tend to be higher mileage, edgier, rougher condition vehicles that a franchise dealer would not stock and should not stock in inventory, right? But an independent can. But now independents are looking at that inventory and say it's too much risk.
Right.
Right. I have floor plan companies that's not willing to finance that much on that car, and I have my banks. I don't have that many banks will let me borrow that much on that vehicle for my type of buyer. All right. So I think the future is really, really bright for savvy independents, and that, like I said, that savvy franchise dealer who's really good at used vehicles, because they have an edge over independents. They've got the shingle. Because they have a shingle, they have access to retail operating lenders.
Right.
Right.
Less of a risk to the lender when you've got a shingle than when you don't. Now, where are we at numbers wise in the first six months of the year?
So I was not able to get that data for us yet, but we're on pace to hit right about 15 million, which is what the normal, barring any major catastrophe like interest rates or whatnot. So if we hit 15 million new vehicle sales, everyone's gonna be like, yeah, we did it. But the reality is we had 16,900 franchise rooftops. You divide 15 million sales by that many rooftops, that's about 75 new cars per rooftop.
Right.
And you and I both know there's some mega stores that are selling 1,000 new cars a month.
Yeah.
Right. So that means that there are some, go ahead. Yeah. There's some new car stores that are going hungry. They're just not going to get the inventory that they need to be able to hit that 15 million SAR rate. So that goes right back to the 2 points I keep saying. Even if we hit 15 million, that's 75 new cars on average across the board. And then we got those high. That's nothing. You have to have a used car operation to stay, and a service department to stay profitable. You have to. There's no question about it. But if you're depending on the lane, and believe me, they're one of my best clients. Love the auction. The quality of the inventory that's flowing through the auction is not what franchise dealers need, and it's definitely not what independents are looking for. So where do you go? Where do we go find this hard to get inventory that we know is going to be we are forecasting out to 2027, and we're not seeing a return of normal pre-COVID levels of inventory. And it's a lot to think about here. So
wait a minute. Are you saying 4 years out?
4 years out. And when you take a look at everything that's been sold up until the beginning of this year, we sold 15 million fewer new cars over the last 3 years than normal. So that's 15 million fewer returning used cars for the next 3 years. Right? Then,
but wait, there's more.
Yeah.
Yes, there's voluntary repos, But there's also a lot of people that aren't going to do that, that aren't going to be able to get out of their cars and are stuck in there. So as we get towards the a little bit deeper into the show, I'm going to share some tips with how to kind of proof yourself from some of that. But that's crazy, man.
Oh my God! If I could, and it'll be in my blog when I put it out there, because it tells a story. I went back and took a look from 2014 sales. Every year,
yeah,
we charted out the, what percent of the vehicles can we expect that are returning are consumer trades or straight out buys, lease returns, repossessions, rental returns, and other fleet. And back to 2014, pretty consistent trend. We're going to see a slight uptick in 2024, and that's because we're going to be we will see a doubling of rental returns in 2024. Now, bear in mind, what did we talk about on the rental? Most of those weren't new cars; they were pre-owned inventories. Right. So we're going to, and then all those new vehicles that were sold in the last 3 years, we know were sold over MSRP and for extended terms. All the used vehicles that were resold for the last 3 years, same thing, over what they sold for new with extended terms. So we've got a block of inventory that was sold in the last 3 years that we typically would see returning that people can't get out and we can't afford to buy and the lenders can't afford to have. So it's something we'll give. There might be some programs that because there's a lot of lobbying going on between the NADAs, state automotive associations, lenders are lobbying like crazy. There may be some programs to help those people out while protecting the investors.
Government funds, government monies.
Yeah, think cash for clunkers. That was something like that, but cash for negative. I don't know what the answer is. All I know is I see a huge block of inventory that we're not going to see, and a huge block of inventory we can't get.
Cash for embalming fluid.
Right, that's the embalming fluid, right? So where's a savvy independent, right, and a savvy franchise dealer to go get that inventory? The driveway. You've heard me say about this often. The driveway buy.
Yeah.
Right now, Experian, by the way, has got this great report called Vehicles in Operation, Experian Credit. And I'll put the link. It's a great report. There's roughly 300 million used vehicles on the road today. The average age is right at 13 years. Okay. So if the average age is 13 years across 300 million used vehicles, what does that mean to you as a independent with a service shop or a franchise dealer who has a service shop? What should you be doing? And you know what they're not doing? They're not going after every year, make, model 13. They're not targeting that 2013 through 2017 model inventory that's in their backyard, begging those people, bring your car for me. Let me give you a free safety and service inspection. Won't cost you a dime. Oh, and while you're here, I'm gonna give you a check writing offer. And if you're here on one of those inventories and you like my check writing offer, let me show you what you can buy. It may be if you can't buy and you want to keep your vehicle to fix it, I've got 2 or 3 companies that can help you get a buy now, pay later service card that can fix up to $5,000 worth of work. Either way, the dealer wins. They just got to go after the market. There's average age is 13 years, over 300 million of them.
It's important to make note of that, right? Because up until recently, if you Google it, what's the average length of time of cars on the road? It was 12.2 years. So now we're
that was 9 months ago.
Year mark, right? That's huge. And those are great cars to go after. But more importantly, those are service opportunities. These people are in the cars longer. Those cars need more service. And we need to go after that business as dealers. I want to get a couple of comments. Ty Thompson says, I love independent auctions. Russell B. Hill, what great information. And Ty Thompson said, Jason Rice.
That's right. Jason sees it from the retail side of things. So he's seeing it and he's racking his head like, don't you understand what you have here?
Right.
You may not, you've got 100 leads that's hitting your inventory, but it's hitting the most 15, the top 15 vehicles that you sell, and you're getting 100 leads on them. And he and I were joking at the conference last week. I said, my second secret that I was taught in the business is it's a contracted word. He's like, what is it? I said, switch them.
Hello.
Yeah.
The long part of the switch.
Right. And it's an edge. Hold on a second. Hold on. Is that better? Can you hear me now?
Yep, I can hear you fine.
Perfect. So but it's a sales process. It's a consultative approach that in the last 3 years, we've lost that ability.
Now, I want to add to that, okay? It's one thing to get the car, but now you've got to merchandise the car, and you have to make it easy for the customer, all right? We've been talking about digital retailing tools forever.
Right.
And there are still some dealers that are not really hip to the digital retailing tool. They see it as some kind of I got to hold it close to the vest because they're just going to shop me. Well, guess what? They're going to shop you regardless. Okay.
Mm-hmm.
When the customer gets to your website, they need to be able to run the payments on whatever car it is that they're looking to buy. Now, back in the day, when I was a young whippersnapper in the business, we'd have customers come in like this on a Saturday afternoon with a clipboard.
Mm-hmm.
I want to drive those 5 cars. I want your best price on all of them. And then, oh, by the way, this is the first place I'm stopping. I've also got to shop 5 other dealerships, right?
Yeah. The Consumer Reports training model, right?
So, but now, today, the salespeople have it easier than they've ever had it. They can't even appreciate the hate for the clipboard.
Oh, yeah. They have no. I had a young guy. I visit some stores occasionally on Saturdays, and I went to my local Toyota store, and I was talking to a guy, been in the business 3 years. He's like, man, you have no idea how hard it is. It was so tough. I looked at the guy and I'm like, are you kidding me? It is so easy to be in the car business today.
Simple.
What you are used to are lay downs. What's that? People walk in and lay down and you buy anything you got. That's what you had.
Yeah.
Now you've really got to sell. You've got to coach. You got to educate. You have to guide the consumer to make a good financial decision. And if you've got the right data, which like to your point, let's calculate your payment. Drive Time's doing it. Carvana is doing it. CarMax is doing it. They're offering payments right up front.
The successful people are doing it because here's the thing. The customer should be able to, if they can't afford the car, they'll know, right? They're not going to walk into your store and say, oh, by the way, I'm a 500 Beacon and I can only afford 400. They're not going to come in and spill that to you. So if you want to waste time with them, don't use a DR tool or lock it up. But if you're smart, give them the ability to run payments on everything that they're interested in, because that will then filter it down for them to come in for exactly what they need. And better than that, if you can guide them through the process, show them that by doing these 3 steps on the website, exactly how much time it's going to save them at the dealership. When you show them the value to them in being able to work their own payments and how much savings and time it means at the dealership, that just makes your life a lot easier when they come in. And I'm going to add one more thing to that. The rates are high. There's no secret to that, okay? And the prices of cars are high. So longer terms are out there. The longer term is the norm. It's not uncommon today to have a 75-month term on anything.
Mm-hmm.
And look, the car that you have, if it's a new car, guess what? They can buy the same car from you that they can buy from anybody else. So how are you different? And I have these conversations with dealers daily. All right. Paul, if you come into the box and you're ready to buy a car, and you're fine with a $500 payment, we're just using random numbers, and you're fine with a $500 payment for a 75-month term, right? You're fine with that.
Mm-hmm.
But if I exceed your expectations, if I blow your expectations away, how does that make you feel about me as a dealer? And how does that make you feel about that car deal, Paul?
It feels great. Under promise and over deliver.
Here's how you do it. Bi-weekly payments.
Mm-hmm.
How familiar you are with the bi-weekly payments, but That's a tool that you can use to differentiate yourself from everybody else. Most people, or a lot of people, I should say, get paid every other week. So if you tie the car payment to your payment at work, guess what? That 75-month term, you reduce it down to 69 months.
Mm-hmm.
You're buying down your cost,
And your interest.
and you literally own the car 6 months earlier. You think that's going to help some people down the road as far as getting them back into the market?
A good buddy of mine, Guy Manassas, he has a IntelliPayment, IntelliChoice payments, and that's literally what he does is biweekly payment programs. And he's been doing it now for like 20 some odd years, hugely successful with it. But even that is an educated process. It requires that consultative conversation, not condescending, right?
Correct.
There's a thin line between being a consultant and being condescending.
Yes.
And that's a skill. That's a skill that many in the dealership world do not have today. All right. And it requires that educational conversation. It sure does.
Steve Cheshin says, why did Echo Park fail?
Well, they're a major client of mine, and I can't say they failed. They're doing pretty well. I'll say this. I had a lot of people say Carvana is done, right? And then 2 weeks ago, right. They own 1% of all used vehicle sales. 13-year-old model vehicles. They just released a 5-year AI-driven digital marketing relationship strategy. So if you bought a vehicle from Carvana anytime in the last couple of years, you're now getting prompted text messages and emails customized specifically to you based on the vehicle you purchased from them. And it's all AI driven. And it's incredibly personal. Now, a company that's supposed to be failing, quote unquote, right, would never invest that 5 years, would never invest that kind of money to put 5 years forward of retention marketing.
I never counted them out. They've done a lot of good things. They've stumbled, but I never counted them out.
I had a few dealers at last week. So what do you think about CarMax? When you think they're going to go down? I started laughing. And I said, not. I said, one company, we're talking about right now, one business, owns 4% of the entire used vehicle sales of 13-year-old model vehicles. How do you expect that to go south? They've got the greatest combination of brick and mortar, digital, online, and now they're buying more cars directly from John Q. Public than the top 4 dealer groups together.
Wow. And aren't they wholesaling a percentage of those cars to franchise dealers?
Yep, they certainly are.
And they're making money.
They're making money. It's identifying what you and I keep talking about. What's the difference? How do you differentiate yourself? What kind of process? My strategy, PPT, right? People, process, technology. Yeah. Right. You can have the best people, but if you got a crappy process and crappy technology, it's not going to work. You can have the best process, but crappy people, crappy technology, not going to work. Best technology, crappy people, crappy process, it's not going to work. You got to have all three. And it's a culture. It's a what's the right word? Rabid. It's a rabid, infectious culture.
And the fish stinks from the head. It's got to come from the top on down.
Mm-hmm. So check this out. Here's some stats I learned that I think you'd appreciate on the recon side. That when I talk about the top 6 things a dealer should do to be ready for, to really get ahead of a game. Number 5 is invest in your reconditioning process, right? So in 2020, you want to guess what the average recon expense was for an independent dealer?
I don't have any idea.
$1,020. This is data from my friend Jeremy Beck at NIADA last week.
That's high. Wasn't it like 600 just a few years ago? 660.
Right. So they were starting to buy vehicles that required more touch-ups. Let's say, right?
Higher mileage.
Right. You want to guess what it jumped to in 2021? It's almost more than 100, more than doubled, right? So $2,271.
That sounds like an Audi Ace. That sounds like the sports model.
Right. So
Wow.
they were stepping up on reconditioning their vehicles in 2021. They had to, right, to get all the money they can get. All right. They had to overpay for higher mileage AD units to start with, and those units required more upkeep, more maintenance just to make them retail ready. It dropped in 2022, still higher than what it was in 2020, $1,619 in all the average in 2022. And right now, year to date, $1,741.
Now, keep in mind, to keep an open mind on this, the dealers do make money on that recon.
Right.
So
But it also tells me they're not leveraging they're not leveraging a reconditioning strategy that could actually help them maintain still a high quality reconditioned vehicle without investing that much money. There are actually two that I can recommend that can come in and totally change an organization's reconditioning process just by analyzing what we call zones, right? Zone one, just bought the car in and it gets parked here. Should not.
What are the bottlenecks? That's what I love about those recon processes.
Right, and that's one of the biggest points. And then the second point is, how do you leverage? You're gonna. It's like buying oil 6 months from now. Buying futures, right?
Yeah.
If you're going to be, if you're averaging, 500 windshields a year, prepay for it.
Right. No, look at the data.
Right.
And budget
but
for
it requires data to do that. It requires the exercise to analyze the metrics and say, okay, I need to think with logic.
Yeah.
Right. And not my heart.
It's got to be logic driven.
That's right. That's right.
Here's a test, right? You talk to 100 dealers, a good percentage of them aren't using any kind of recon software and don't feel the need for it. Now, here's a test if you're a dealer. Go into the store and ask all of your retail management independently how many days to market for the car that you bought at the auction yesterday.
Right.
How many days to market. And if you have 10 people on your management staff, I'd be willing to bet you money that you'll get 9 to 10 different answers on how long that takes. If you don't measure it, you don't know what that is. We're going to have conversations again. How many days to market now, Paul? How many days from
50? We're right at 50, 51 days to turn right now.
51 days.
No, I'm sorry. You said days to market. The last stat I had was 9 days.
9 days. Okay. And then how many days supply do dealers have? Not short supply ones. I'm talking about the ones that have a lot full of Dodge pickup trucks.
So I can on a national level, we're right at a 50-day supply.
So we're going to have the conversation in the not too distant future about floor plan expense. Right? That's coming.
Yep.
And without this recon software, you don't really know. It's a crapshoot.
Right. And that's one of the keys, right? But that also factors into you and I've had this conversation. What is the cost per day by unit, by bucket, right? And you've heard me talk about this negative margin compression that's been coming. So went back and I took a look at the data, right? In January 2020, the average spread between the average wholesale price across the board, and the average retail listed price, the average spread was $7,500. Pretty healthy margin. But obviously, there's a lot of factors that eat away of that margin. You got your reconditioning, you got your transportation, you got your marketing, you got your commission structures, your salary expenses. All of that's it's not being included in it. But there was $7,500 to absorb. And let's fast forward to when I started talking about it was in December. It was in 2021. So December 2021, the average wholesale price was $24,250. $225. The average listed retail price the week of December 2021 was $29,500. That's $5,275. So we went from January 2020 to December 2021, we went from 13.5 average wholesale purchase to 24.2. That massive jump for the same type of car.
Wow.
At the same time, our asking price, the spread between what we paid versus what we could ask, dropped from $7,500 to $5,275.
A third.
Today, huh?
A third.
A third. That's called negative margin compression. You're still making money, but you're not making all you should. And if you're not paying attention to that number, that metrics, then then it's not prompting you to say, well, okay, let me look forward, let me look in the future and see, okay, this is a trend now. It started in 2020. This is where I'm at in 2021. Where am I at today? Right now, as June 1st, my average wholesale listed price was $23,575, and my average retail listing was $28,400. That margin, the difference in margin is $4,825. I was at $7,500, then it dropped to $5,275. Now it's at $4,825. You follow my trend of the negative margin compression I started talking about 2 years ago. Look at that metrics to understand all the other metrics in your store that you need to be working on. So yes, there's potential to make a good profit still, but look how much you gave up.
Right. The market's changing. We're getting back into where dealers are starting to get slapped in the face with the whole importance of fixed ops again.
Yes. Yes.
And what's still crazy about that is that they invest monies in things that they don't use, right? They'll spend 90 G's, 100 G's on machinery that measures tire condition and alignment conditions. And I watch in store after store, I watch cars just drive into the drive, and nobody is using that machine. Nobody's printing off the sheets that show that the alignment is off. Nobody's printing off, showing them what the tire wear looks like. Nobody. And I'm not talking about 1, 2, or 3 stores. I'm talking about many stores. And again, $90,000 to $100,000 is what companies spend for this. You bring it to some dealer's attention. Oh, yeah, we'll take care of it. But then on subsequent other visits, you find out they're just not doing it. I don't understand that. So the opportunity is definitely there.
Yeah. BAU, business as usual. I'm going to operate business as usual. But that's where the bonus comes in. If you're that savvy dealer, whether you're independent or franchise, if you're savvy and you understand this and you are truly being proactive, looking at the metrics, no emotion, your shoulders, you're far and away and ahead of just about everyone that's going to be out there in the marketplace today. And I want to end with this. Again, all my independents, where do I go get the best inventory for the best price? Driveway buy. You've heard me say this often, right?
Yeah.
So I was did I ever tell you my Uber story? How I helped one guy put about another 31,000 in his retirement account.
Yes, share that with us.
Right. So called this Uber, and it was a 2013 Chrysler Dodge 200. And I remember when it pulled up, I said, man, what is that? That's really sparkly. It's really, wheels were polished. Everything was really shiny. And then when I walked around in front, I reckoned, oh, it's a Chrysler 200. Walked perfect. The car was beautiful all the way around. Get inside, it was completely polished. Older gentleman in the seat. And he's like, why'd you walk around my car? I said, well, it was really shiny compared to all the other cars that, I've been seeing. It was, you really take care of your stuff. He goes, yeah, my wife and I just retired, and we got to take care of our stuff because we're trying to save another $35,000 to top up our retirement account. I went, really? I said, tell me about this car. How many miles you got on it? Told me how many miles he had on it. It was paid for. It was like 75,000 miles on a 2013. No miles. And based on how well this car looked on the outside, you can pretty much be rest assured he was meticulous about maintaining and servicing this vehicle. Come to find out, he had 3 more cars in his driveway. and it was just him and his wife. So they had a 2-year newer 300C, similar mileage, immaculate. Sent me all the pictures in and out.
Yeah.
He had his wife's car was like a 2018 Mercedes. I think it was a 300 if I remember correctly. And then he had a work truck that he had. I was able to refer him to a dealer who had just told me he's looking for more inventory. And before his shift was over, he had sold all 3 vehicles and put 31 grand in his account. And all I did was ask questions.
It's not that hard.
Yeah. That's why you have to train everyone in your organization, top down, front to back. Use a mobile app. Use good data, good technology, because you never know. You might be able to get that unicorn you've been looking for, but it's in people's driveways. And by doing that, you might be helping them out of a stressful situation.
And all of your people, a dealership can have average dealer, anywhere from 50 to 100 people that work there.
Mm-hmm.
All of those people have their own tribe, their own following, their people that they're friends with, related to, work with, go to different functions with. These are all people that like them and trust them. Those are the people that can start the conversations for the cars that you need, as opposed to the generic, yes, you do have to do, we want to buy your car. There's no question there. But I think that the consumers are bombarded with that. If I had the option of, hey, Joe Blow over here, who I don't know, we want to buy your car, or my buddy Fred, whom I know that works at a dealership, that comes up to me and says, hey, tell me about your car, right?
Mm-hmm.
The basic questions that you ask that guy. Tell me about your car. Am I more likely to have a conversation with my friend Fred about a car deal than some stranger that's bombarding me like maybe a couple other 3-4 different dealers?
That's right.
A huge opportunity we're missing.
And it's I've been saying that now going on close to 4 years, right? And I can count on both my hands the number of dealers I know that are actually doing it.
Right.
Yep.
Because they're afraid of giving up control.
Right.
You're still in control.
Right.
All they're doing, they're loading the tool. That's all they're doing.
Mm-hmm.
They're not guaranteeing a number. They're loading the tool. They've established the trust with these people. They're giving you that information as the team of buyers. And I say team of buyers, because if you have only one guy or one gal doing it, you're missing the boat.
Mm-hmm.
Because you've got a dire need. You need people available at any given time to be able to do that. So that's a team of buyers. So yeah, that's again, on my YouTube channel, there are videos about just that. And if you follow Paul's his vlogs, he talks about stuff just like that.
Mm-hmm.
The great thing about LinkedIn and YouTube is that we have so much information available to us because people like us and others put out content to help you to make better decisions. So when you get a chance, if you could put the link, when you do the vlog, put the link to that in this thread here, because I think if people see the actual charts, then we all learn differently. Some learn by doing, some learn by seeing, some learn by hearing. So if we can put that piece with it as well, I think people will get more benefit out of it.
I agree. And as always, I enjoyed our conversation and sharing this information with the audience, and hope everyone found value in it.
Paul, thank you very much, man. I always love talking shop with you. To those that watched it live, thank you. To those watching it on the replay, thank you. If you see value in what we talked about here tonight, and you see somebody that might benefit from the info, by all means, share it with them. And if you're not connected with me or with Paul, by all means, we like to connect with people that are relevant in our industry. If we can help you or you can help us, send us a connection request. So with that, I wish you a safe and successful next week, and we'll see you next week on Sunday Night Live. Thanks again, Paul.
Thank you, sir.